Imagine two investors in Pakistan. Both start investing with rupees 10 lakh. Both invest for the next 20 years. Both stay disciplined and never panic during market crashes. Yet after 20 years, one investor has built significantly more wealth, while the other enjoys a steady stream of passive income without selling a single investment. Same starting amount, same investment period, same discipline. So what made the difference? It wasn't luck. It wasn't choosing the perfect stock. It wasn't predicting the market. It was a decision they made on the very first day. Should they invest in a growth ETF or a dividend ETF? Now here is something interesting. Imagine one investment compounds at around 12% annually while the other grows at around 9% annually, but also pays regular cash dividends that are reinvested. Neither approach is automatically better. One focuses on growing your wealth faster. The other focuses on generating cash while still allowing your investment to grow. Understanding that difference is far more important than chasing the highest recent return. Because if you are investing from Pakistan, the answer isn't as simple as copying what investors do in the United States. Pakistan's ETF market is still developing, so today we will first understand the growth and dividend ETFs currently available on Pakistan Stock Exchange. Then we will see why comparing them directly can be misleading. Finally, we will briefly look at two globally recognized ETFs, not as recommendations, but as educational examples to understand the investing philosophies behind growth and dividend investing. By the end of this video, you will know which strategy is more suitable for your own financial goals. Welcome to Omni Skills Lab. Let's begin. What is a growth ETF? Before comparing growth and dividend investing, let's first understand what a growth ETF actually is. A growth ETF invests in companies that are focused primarily on expanding their businesses. Instead of paying most of their profits to shareholders, these companies reinvest those profits. They build new factories, develop better products, expand into new markets, acquire competitors. The goal isn't to generate income today. The goal is to become much more valuable over time. Think of it like two shop owners. The first owner earns a profit and immediately spends it opening another branch. A year later, he opens another, then another. His income today may not look impressive because he is constantly reinvesting, but over time, his business becomes much larger. That's the philosophy behind growth investing. Let's see what that means for an investor. Imagine you invest rupees 10 lakh into a portfolio that grows by an average of 12% per year. Without adding another rupee, after 20 years, your investment could grow to almost rupees 96 lakh through the power of compounding alone. The exact return will never be guaranteed. Markets go up, markets go down, but this example shows why long-term investors care so much about growth. Small differences in annual returns become enormous over long periods. In Pakistan, one of the closest examples of a diversified growth ETF is the NBP Pakistan Growth ETF. Rather than buying shares in one company, investors gain exposure to multiple leading businesses through a single investment. Its holdings include companies from sectors such as commercial banking, oil and gas, fertilizer, power, technology, cement. Instead of trying to predict which company will become tomorrow's winner, you are investing across many established businesses. That's one of the biggest advantages of ETFs, diversification. If one company has a difficult year, other companies can help balance the portfolio. Growth investing isn't about finding one superstar company. It's about allowing a collection of quality businesses to grow over time. Of course, growth investing also comes with greater price fluctuations. Some years, your portfolio may rise sharply. Other years, it may fall significantly. The market does not test your intelligence. It tests your patience. Now, imagine another type of business. Instead of expanding aggressively every year, this company generates steady profits. Rather than keeping all of those profits, it shares a portion with its owners. Those payments are called dividends. A dividend ETF invests in companies that regularly distribute part of their earnings to shareholders. These businesses are usually mature companies with stable cash flows. Many investors appreciate this approach because they receive regular income while still remaining invested. But here's something many beginners overlook. Receiving dividends does not mean spending them. Imagine your ETF pays you Rs 50,000 in dividends this year. Instead of withdrawing that money, you immediately use it to purchase more ETF units. Next year, those additional units may also generate dividends. Then those dividends purchase even more units. This creates another form of compounding. You are no longer just earning dividends, you are earning dividends on previous dividends. That's why many long-term investors automatically reinvest their dividend income. On the Pakistan Stock Exchange, investors looking for dividend-focused exposure often come across the JS Global Banking ETF. At first glance, it appears to be Pakistan's dividend ETF. However, there is an important difference. Unlike diversified dividend ETFs available in larger international markets, JS Global Banking ETF is primarily concentrated in the banking sector. That means its performance depends heavily on how Pakistani banks perform. When banks generate strong profits, investors may receive attractive distributions. When banking profits decline, those distributions may also change. This makes it very different from diversified dividend ETFs that spread investments across many sectors. Why we can't compare them directly? At this point, you might ask, why don't we simply compare NBPGETF ETF and JS Global Banking ETF and declare a winner? Because doing so would be misleading. Pakistan's ETF industry is still young. There are only a limited number of ETFs. Most have relatively short performance histories, and Pakistan does not yet have a broadly diversified dividend ETF comparable to the largest international funds. That's why using only recent Pakistani performance data would give an incomplete picture. Instead, it's better to understand the investing philosophies behind growth and dividend investing. For that, we will briefly use two globally recognized ETFs as educational examples. One of the world's best-known growth ETFs is Invesco QQQ. It owns companies such as Apple, Microsoft, Nvidia, Amazon, and Meta. These businesses continue investing heavily in innovation and expansion. Instead of paying large dividends, they focus on becoming more valuable. But growth investing isn't always comfortable. Imagine your Rs 10 lakh portfolio grows to Rs 16 lakh over several years. Then a major market crash arrives. Your portfolio suddenly falls to Rs 12 lakh. Nothing about the businesses may have fundamentally changed, but many investors panic and sell. Years later, the market recovers and the portfolio reaches Rs 22 lakh. The biggest challenge wasn't choosing the investment, it was staying invested. That's why patience is one of the greatest advantages a growth investor can have. Now consider one of the world's best-known dividend ETFs, SCHD. Instead of concentrating on fast-growing technology companies, it invests in financially strong businesses with long histories of paying dividends. Its objective is not explosive growth, it's consistent profitability and reliable shareholder income. Now compare two hypothetical investors. Investor A owns a growth ETF, Investor B owns a dividend ETF. After 10 years, Investor A's portfolio may be worth more than because the businesses grew rapidly. Investor B's portfolio may be worth slightly less, but throughout those 10 years, they also receive regular dividend payments. If those dividends were reinvested, the difference between the two strategies may become much smaller than many beginners expect. That's why experienced investors don't look only at price appreciation, they look at total return, capital growth plus reinvested dividends. Neither philosophy is universally better. Each simply serves different financial goals. Now let's bring everything back to Pakistan. If your goal is maximizing long-term wealth and you have many years before needing your money, a growth-oriented strategy may suit you better. If your priority is generating regular investment income, a dividend-oriented strategy may better match your objectives. But remember, this does not mean to be an either-or decision. Imagine three investors. The first invests entirely in growth ETFs, the second invests entirely in dividend ETFs, the third splits their portfolio equally between the two. During strong bull markets, the growth investor may perform best. During periods when regular income becomes valuable, the dividend investor may feel more comfortable. The balanced investor may never lead the race, but they may also experience fewer extremes. The best portfolio isn't always the one with the highest possible return. It is the one you can stick with through both good markets and bad markets. Pakistan's ETF market is still evolving. As more ETFs become available, investors will have greater flexibility to build diversified portfolios. But one lesson remains true regardless of where you invest. The people who build the most wealth are not usually the ones who discover the perfect ETF. They are the ones who start early, invest consistently, reinvest their returns, and allow compounding to work over decades. So, Growth ETF or Dividend ETF? Growth ETF focus on building future wealth by investing in companies that continue expanding. Dividend ETFs focus on generating regular income from profitable businesses while still allowing long-term growth. Neither is automatically better. The better choice is the one that matches your financial goals, your investment horizon, and your ability to stay invested during market ups and downs. Because successful investing is not about finding the perfect ETF. It's about giving good investments enough time to work. If you found this video helpful, consider subscribing to Omni Skills Lab for more practical investing and personal finance content. And let me know in the comments, if you had to choose today, would you invest in Growth ETF, a Dividend ETF, or a combination of both? Thanks for watching, and I will see you in the next video.